Why investors stop caring about interest rates. One of the biggest mindset shifts that happens when people become experienced investors is they slowly stop obsessing over interest rates the way normal consumers do. And I know that probably sounds crazy at first. Hey guys, this is Sal Bossio with Mortgage Universe on YouTube. Because obviously rates matter. I'm not saying they don't, but newer investors often think, if rates drop, then I'll invest. Meanwhile, experienced investors are usually asking a completely different question. And that question is, does the deal make sense? AKA, does the property cash flow? That's the shift. Because once investors really understand leverage and long-term investing, they stop viewing real estate as a monthly payment and start viewing it as an asset acquisition strategy. That's a completely different mindset. And honestly, I think a lot of newer investors accidentally become kind of paralyzed waiting for the perfect market conditions, perfect rates, perfect timing, perfect prices, perfect economy. But the reality is perfect conditions almost never exist. There's always something. Rates are high, inventory's low, prices are high, the economy feels uncertain. Something always feels uncomfortable. And what's interesting is experienced investors understand that waiting also has a cost. Because while people are sitting on the sidelines waiting for perfect rates, they may also be missing cash flow, equity growth, appreciation, rent growth, tax advantages. That matters over time. And by the way, if you guys are into these kinds of conversations, real estate investing, DSCR stuff, definitely like and subscribe because I'm going to be talking a lot more about this kind of thing. Now, obviously, rates can absolutely affect cash flow, especially for DSCR investors. A higher rate can change. DSCR ratios, monthly cash flow, leverage options, all of that matters. But experienced investors also understand something newer investors often miss. Rates change. Deals can be refinanced. But missing a strong asset entirely because you waited years trying to time rates perfectly, well, that can become expensive also. And honestly, some of the wealthiest investors built huge portfolios in environments where rates were much higher than today because they focused more heavily on asset quality, cash flow potential, location, long-term demand, not just, the immediate rate itself. And another thing investors become obsessed with over time is fixed rate debt. That's a huge mindset shift as well because inflation changes how people think about borrowing long-term. Imagine holding a fixed mortgage payment while over time rents rise, property values rise, income rises. That dynamic becomes extremely powerful over long periods of time. That's one reason so many sophisticated investors stop viewing debt emotionally and start viewing it strategically. And I think social media confuses newer investors also because everybody online constantly acts like now is either the greatest time to buy ever or the worst time to buy ever. But it's always in extremes. Meanwhile, most experienced investors are usually just calmly analyzing cash flow, risk, reserves, long-term opportunity. They're thinking, in decades, not thinking in headlines. And I think that that's one of the biggest differences between newer investors and experienced investors overall. Newer investors often focus heavily on, timing the market perfectly. Experienced investors focus more on time in the market, consistency, ownership, long-term asset accumulation, because eventually investors realize that the perfect rate usually matters less than owning the right assets long-term. And honestly, I think that's one of the biggest mindset shifts that separates people who think like consumers from people who think like investors.